Hi, everyone. Thanks for joining us. Welcome to the panel. We are joined today by a great group of panelists to discuss the current financing and M&A trends within the DaaS industry. My name is Sean Hugh, and I'll be your moderator. For those that know me from MVP Capital, we were recently acquired by Houlihan Lokey over the summer. Houlihan Lokey is a global investment bank with expertise in M&A, capital markets, restructuring, and valuation. According to Refinitiv, which used to be Thomson Reuters, we've been the #1 M&A advisor for the past 5 years in the US, the #1 global restructuring advisor for the past 6 years, and the #1 global M&A fairness opinion advisor for the past 20 years. My team and I are solely focused on wireless infrastructure, and I've done hundreds of transactions within the tower space, equating to several thousand towers. And more recently, we've done half a dozen or so DaaS transactions over the last couple of years. With that, let's introduce our panelists. I'll let each of them introduce themselves, telling us a little bit about them, their company, and their experience in the DaaS space. Ryan, why don't you kick us off, and then we'll turn to Justin and then over to Patrick.
Sure. I am Ryan Lapine. I am the co-president of Peppertree Capital. Peppertree was founded in 2004, and we invest in one thing, and that is communication infrastructure. For us, as we define that, it's towers, it's fiber, it's DaaS, it's spectrum, and then sort of appropriate application from there as we look at helping carriers and others alleviate some of those capacity issues that they're facing with their networks. We have more than $2.3 billion of assets under management across 8 funds and a small debt fund, and are actively deploying again out of our 8th fund and looking for opportunities in the communication infrastructure space.
Okay, Justin, if you want to take it away.
Sure, thank you. Good afternoon. Thanks for your time. Thanks for inviting me. My name is Justin Marin. I'm the CEO and founder of Strategic Venue Partners, or SVP, as we like to say. I have a long history of investing and developing infrastructure from communications to renewables. I was some of the largest investment banks out there, name it, GSO, Blackstone, Goldman, Barclays, Fortress, and now we're with Tiger. I personally cut my teeth on building cell towers and rooftop sites across the country, over 20 years ago, and I just haven't looked back since. The common thread, I guess, with everything that I've been involved with was that there's always an underlying driver, and that was, how do we provide the right solution? And as my partner Chad likes to say, we're here to solve problems. There's been a problem with how wireless infrastructure has been built out, specifically DaaS, public safety, Wi-Fi. In the past, we believe that our offering addresses those problems and then some. We believe wireless is the fourth utility, and people should think of it that way. And this is critical infrastructure that needs to be built out. Just a little bit on SVP. At SVP, bring on for critical infrastructure enterprise market. We design finance structure such as DaaS, Wi-Fi, public safety, fiber, IPTV, even kind of segued a little bit into some GPON and security systems, and overall owning all the communication infrastructure at a location. A core value prop is easy. We're delivering an all-inclusive turnkey wireless holistic managed service, really changing CapEx to OpEx for some of these folks and utilizing the PMs and certified partners to build this. We're predominantly focused in healthcare and hospitality, gaming, retail, and then a little education. And look, we're a little fund. We're nowhere, a little group rather. We're nowhere near, Ryan's with $2.2 billion to work. Where we put some good money to work, and we're certainly punching above our weight class with a limited lean team we have. But we have some of the sought after, in building projects right now in the country, and we're only adding to that as we go forward.
Great. Thanks, Justin. Patrick, if you want to take it.
Sure. Hey, my name is Patrick Fear. I'm a managing director at AB Private Credit Investors, which is a $10 billion platform affiliated with leading global asset manager AllianceBernstein. Put simply, we lend up to the order of $200 million plus to borrowers to help facilitate their growth or transaction activity. I lead our digital infrastructure and services practice, which we have made about $1.5 billion commitments during the past 5 years. And we've lent specifically a number of times in the wireless space, and then are one of the, the leading lenders to the DAS or in-building or neutral host space, having at a predecessor vehicle led the first institutional financing for Extenet. Currently, we finance Connectivity Wireless, formerly known in some parts as Neutral Connect Networks, and amongst some other tower assets in our portfolio. And we've got strong appetite to continue to help to facilitate the growth that I think we'll touch on today.
Great. Thanks, Patrick. So let's get started with the first question. So what has been your experience so far in 2020? How has COVID impacted your company and decisions around financing new systems, funding new investments, and M&A in general? Patrick, we can start with you, and if you just give us a lender's point of view on the topic.
Sure, perfect. So just bridging back to what I just said, we continue to have strong interest to finance in-place cash flows and growth capital as those cash flows increase for the borrowers and the operators and the equity investors in this space. What's really happened during this COVID time, as it relates specifically to these businesses, is that we've seen the in-place cash flows that have strong contractual backing and recurring characteristics maintain absolutely as one would have expected. We have seen a little bit of an impact on the portion of cash flows that in the industry we call BB&B, or book but not build, that we might lean forward into in terms of growth that we believe on a calculated basis absolutely will materialize. Some of that has pushed out to the right due to lack of availability, in some cases, of construction activity to get into venues, for instance. But generally speaking, that's something that we've felt will still come, that has had a little bit of a deferral. So that's not really had a significant impact on appetite. And then I think what we've seen is anybody that could is moving forward with installation, including commercial buildings, because if they've already had it budgeted for and there aren't tenants in place, they do see the value of it as the fourth utility, as Justin's mentioned. I think I'd be interested in some of the panelists' views on, long-term, how one calculates or thinks about that demand, but so far so good.
And has the current environment changed your view on, rates? Generally your investment terms, have they changed around the space, or, are the fundamentals still strong enough that they support the rates and terms from pre-COVID?
Yeah, I wish it had changed our view. I think our investors, knee-jerk reaction during a time of, at a macro level, more global uncertainty than we had in February, or at least we know about more uncertainty than we thought we had in February, is that there will be additional risk premium, to be had at large for the credit investments we make. And one of the things that we've needed to do is think through that long and hard and make sure we communicate in the right way. And that has resulted in a space like this, us being able to make credible arguments about risk. If you think about it from a tower perspective, with the noise around the Sprint and T-Mo merger being cleared during this time, there's a lot of risk that's come out of that system. And so with the puts and takes of those moving things, you really more or less have ended up with pricing that is likely to be not too dissimilar to where it was before.
Okay, fair enough. Ryan, if you want to take it next, how has COVID impacted the way you view investments, your operating companies, et cetera?
Sure. So, I think overall, as you sort of take a step back, I think everybody that is investing in this space, lending in this space, participating in this space, believes that data demand continues to grow. And again, I think in the face of a pandemic, particularly as people are working from home, or my kids working remotely for school, or others that are no longer situated in the office but are remote. That's leading to an increase in data demand, and with that, there's certainly a need for additional infrastructure. I think what you also see in times like these is a bit of a flight to quality. So I know if Patrick is looking at what he might be lending to or what his group is lending to, or from our perspective as we look at what we want to invest in, you look at predictable, stable cash flow. You look at assets that are growing with that increasing data demand that I mentioned, and it is a place where you're looking for new opportunities and new ways to invest. And certainly that's held true for us. Again, we really haven't slowed down since inception, and I don't think whether it's COVID or anything else, it is going to slow us down. We want to continue to find good opportunities in which to invest. We're actively talking to management teams, looking to provide additional capital, and hope to continue doing that. So from our perspective, it is business as usual, and all systems go. And again, just looking for good opportunities and good management teams in which to invest.
Has the recent environment changed your thinking about either size of investments or return thresholds at all, or is it similar to what it was pre-COVID?
I think it's really similar to what it was pre-COVID. Again, from our perspective, we do take a long-term view and realize that collectively we will all get through this, and it doesn't do away with the underlying data demand trends. Data demand will continue to grow in the face of a pandemic or quite frankly anything else. And again, if you've got a long-term horizon like we do, you want to use this time to align with good management teams and find good opportunities and continue to grow the business.
Okay. And then Justin, if you want to take away answering the same question, has COVID changed how you manage your business? Has it changed anything operationally?
Yeah, I mean, look, at the end of the day, we actually grew through COVID. There's always blessings in some of these horrible outcomes or situations, I guess you'd say. Specifically, we were building out a lot of malls, and those retail centers got shut down. We had a short window. So our crews were able to catch up and build all through the day as opposed to building throughout the night. And we actually delivered projects much earlier than anticipated. But we're hyper focused with COVID on our exposure to certain verticals. I mean, if I came to you and said we have a lot of retail, hospitality, gaming, and healthcare, exposures where we have a lot of our systems, you may recoil at the retail and gaming side of it, but we're focused on the crown jewels of those areas, right? So for every investment grade resorts world we have in Las Vegas, casino, we're pushing away from some of the ones in the Midwest that we may have done a couple of years ago or a year ago, that we're not sure if they're going to make it. And so that's certainly been a focus on us. And of course, from a pricing perspective, we answer to our investors, and their question and response is always get more yield, and price it better naturally and price it higher. So that's it from our side.
Okay. Well, that actually segues pretty well into my next question. Historically, stadiums, venues, and commercial real estate has really driven the majority of activity in the DAS space. Do you see that continuing to be the case, or will something like healthcare or some other verticals be driving activity going forward? Justin, you can start with you, and then Ryan and Patrick, feel free to jump in as you see fit.
Sure. I mean, from our perspective, my perspective, and I push our company in, we're not focused on stadiums. I think they're pretty well covered. I think commercial real estate is and have focus on real estate. I think it's is going to be trouble. It's not an area we focus on. I think my brother-in-law runs a portfolio for Vornado in the city. They haven't had any terminations on their leases yet, but they have law firms and hedge funds, right, that are their primary tenants, like professional outfits, and their buildings are 15% occupied right now. You know, I'm sure Manhattan will come back, but I think the carriers will push away from pieces like that if you're looking to the carriers to be your counterpart in those areas. From us, one of our original focuses and continues to be a vertical for us to focus on is healthcare. Quite honestly, we were building hospitals during the pandemic, which is challenging, right? You know, we had to work our crews around overflowing. You know, we had to take onto account, do we want our low voltage guys in there doing work during the pandemic and put them at risk? If they're in the buildings, what floors are they on? Where's the spillage of overage, you know, of the patients? You know, where are they going to and what floors and where are we? So that was a challenge. But healthcare, I believe, and the carriers are certainly coming around to this in a big way, is it's going to be a big push, right? You have telehealth services, artificial intelligence, 5G. A lot of these things are going to play into why healthcare and building up an infrastructure, at least from an SUV perspective, is so important. And that's really why we put a lot of our eggs in that basket and continue to do so. I think that's going to be a bigger push event, foot traffic and the same return investment for the carriers, but I think they're going to participate somewhat in those areas where they haven't before.
Right. Have you seen the carriers, push you into a certain vertical at all? Have they been, moving away from commercial real estate into things like healthcare or moving away from hospitality and moving into things like healthcare or industrial or something to that effect?
The conversations have been a lot smoother, let's put it that way, right? So I think pre-pandemic, we were out evangelizing to all these hospitals that, don't you know, you have this old infrastructure, it needs to be all built out differently. They thought about, we've been traditionally CapEx, for our infrastructure. The carriers haven't traditionally funded this, which also means that the 3POs and the like would not be participating in healthcare because they use the carrier monies to build out their infrastructure. It's not an area we look at. And whereas before the carriers were more apt to say, here's signal source, specific a certain amount of a certain amount of foot traffic that they can cover. Before they were willing to give signal source sometimes. I think they're opening up their wallets a little bit more and recognizing that this is going to be a good push. Again, not something we're focused on. I don't know if they're pushing away from commercial real estate. Again, it's we let everybody else go after that and don't focus on those areas. But as far as healthcare is concerned, we feel we have a good stranglehold on it as one of the groups that does that, and it's becoming more and more favorable to the carriers.
Great. And then Ryan, I guess with your portfolio companies, I know a lot of them have been focused on things like commercial real estate, smaller venues and stadiums. Have you seen any pushback from carrier activity in those sectors? Do you see, any of your portfolio companies pushing into new verticals because of it, anything like that?
Yeah, so I think when you sort of boil it all down, I mean, the whole concept is that you're looking to increase capacity where the end user is, wherever that end user is. And if they're in stadiums, if they're in commercial buildings, if they're in hospitals or wherever they're spending their time, you're looking at perhaps antiquated infrastructure or infrastructure that didn't exist previously, where folks are now demanding increased capacity, increased coverage, et cetera. So, from our perspective, I think, our portfolio companies will go where the opportunity is. And, they listen to venue owners, they listen to carriers, they work with them to assess, what their needs are, where they want to be, and, sort of put the pieces together to solve those issues. So, I think, we're busy with any and all of the above that you mentioned, and expect that to continue well into the future here.
Okay. Patrick, anything you want to add here, or should I move on to the next question?
Yeah, just quickly, I think, what you're hearing from folks is there's some puts and takes on all this, right? And each one of these, each of us with our, approaches to investment are going to look at the differences of, a venue counterparty versus a carrier counterparty, carrier with lots of sites, versus limited sites. But for the most part, it all, because of the accentuation of the mission criticality of this, the demand for these services that Ryan talked about in data, that's really happened during this period, which we all knew about and we all lived it. And to some extent, I think we couldn't even sometimes see the forest for the trees, right? People are really, seeing and understanding the need for all this stuff. And so I think there may be some changes around. And I think those of us that are deep into this are going to be able to alter and tweak for that. But I generally think it's going to be, a tweak, because what you have is a fourth utility with generally really good counterparties on the other end of it.
Got it. Okay, so going to my next question, as Justin had alluded to earlier, the T-Mobile Sprint merger has kind of cleared through. How has that affected the space? Has the emergence of Dish made a difference? And if not, do you think Dish will have a significant impact going forward? Will this affect how you think of funding new systems because you potentially have more carriers, or you have a stronger third carrier, or are you valuing your existing assets differently? Ryan, how about we start with you, and then Patrick and Justin, feel free to jump in whenever you like.
Sure, and I think Patrick might have touched on it, earlier in the discussion. But as you look at Sprint and T-Mobile, obviously you had some overhang there as that was moving through, the process and moving to a closing, and that was, obviously with the approval and the merger going through, that sort of temporary uncertainty, so to speak, was lifted. And now, we know where the pieces fall. So, I think from a DAS perspective, from a communication infrastructure perspective, eliminating uncertainty is good, because then, the carriers know, who their foes are, so to speak. They know what their priorities are. They can start focusing on the business as opposed to anything else. And I think as we look forward, that's what we expect to see happen, for many years to come. As it relates specifically to Dish, I think we view them as a formidable carrier, and will be obviously need to build out venues and their network, and hope to work with them and partner with them going forward to do just that. But I think that's true of all the carriers. I think our companies are looking to solve their capacity issues where they can, in whatever venue we need to be in to help them. And the goal is to help all the carriers, and again, alleviate some of the bottlenecks that might be happening in some of these venues.
Has that merger affected how you value new opportunities, or even your existing portfolio of towers and DAS, in terms of lease-up potential or credit quality of now your third carrier? Do you see this as something that's beneficial for you in the long term? How do you view that from an investment standpoint?
Yeah, I mean, again, I think what we always look at and what our thesis has always been is that growing data demand is going to overwhelm the wireless networks, and you need to come up with a solution to help the carriers and other users of communication infrastructure. So, I think if you look at that, you take the uncertainty out of the mix, you add another carrier to the landscape, I think that's generally positive, but it's really all premised upon growing data demand, and that really hasn't changed from our perspective. Again, the trends are positive, and we expect that to continue going forward. So, I don't know if it's changed our mindset as it relates to valuation, but I think, again, to the extent that we can help all of the carriers, venue owners, et cetera, we want to do that, and we think that's good, not only for for us and our investors and our portfolio companies, but for the industry in general.
Yeah. Hey,
Okay,
Sean,
have you seen any? Yeah, go for it.
Real quick, just on that. I mean, I think it's, at least from what we've seen, right? And we're in a slightly different place in the food chain, but we haven't seen people changing their models because of it yet, right? Now, I think undeniably there's some boot value, to an industry where you felt like there could be 3 or 4 active players, but people, also have the memory of the last number of years where no matter how you looked at it and shifted the pieces, there was really kind of 1.5 active at any time. And I think, as we see people get more comfortable to modeling and counting on some of that, then I think it'll have those, ripple effects of being more tangible rather than intangible, boot type value.
I think
Have you
that's the
seen-
data throughput, as Ryan was touching on, by the way. I mean, I remember the days, and I took a picture of one of my first cell towers ever built. Singular, Sprint, go down the list, right? They're all tenants on it. Guess what? They're still there. They're under different names, but they've consolidated the space and they've kept it, right? Like these are just, it's location, right? It's usage. It depends on when they are. We've been talking to Dish. They're hitting a bunch of macro sites for us, more rooftop than anything. They haven't fully gotten in bed with us on in-building yet, but I think they will. I think whenever we looked at Sprint previous to this, I just automatically discounted their value. I figured they'd be, either team. It depended if it was 2.5 or not was in place. If 2.5 was in place, and T-Mobile grabbed them and continue on that location if the economics are favorable to them. But I think it's good that, like your guys saying, that dust is settled. Dish is in the market. There's another person to play and participate, and let's see how they build out over the next couple of years.
I guess, have you seen, both to Ryan, your portfolio companies, and Justin, have you seen Dish be more active than Sprint was? So is it a positive if you call it interchange 2 carriers?
I think right. In order to retain their licenses, they have to be active. At least in the short term here. Sprint has been, we acquired or supplanted an existing or an anchor 3PL to location, a portfolio, and we were talking to Sprint like, what's going on, and they kind of were looking around like, I don't know, does he know? Like nobody knows what's going on here. We're kind of just sitting and waiting until this merger goes through. But T-Mo has kind of stepped forward, and they're now because obviously we're talking to them about those sites for themselves, but they're now actively pursuing those ones that had 2.5 in for sure. Sorry, Ryan, go ahead.
No, I think I don't know if I have much to add there. I think we've been impressed with with the team at Dish and what they've been doing. And some of the discussions that we've been having, but that's true of the other carriers as well. I think everybody is trying to do their best and build out their networks, and again, all the carriers are have some very talented people there, and they're trying their best to keep up with this data demand, and we're here to try to help them.
Okay, great. Anyone want to make any last closing remarks? Otherwise, I'll wrap up the panel. Okay, great. I think we covered a lot here today. Well, that wraps up our panel. I want to thank our panelists for participating, NEDAS for putting on this event, and all of you for joining us today. And with that, I'll open up to questions.